Good evening, friends. So we are once again back, this time on disallowances. So the disallowances are very important from the point of view of examination because you compute business income by starting from accounting profit. So all expenses which are debited in P&L account, we have to find out whether the expenditure is allowed or not allowed. So if the expenditure is not allowed under the provisions of Income Tax Act, we add back, and those expenses which are debited in P&L account but not allowed for tax is what we call it as a disallowance. So disallowance are there in various sections of Income Tax Act. Section 38, Section 40A, Section 40 capital A, 40B, 40BA and 43B. So Section 38 basically deals with expenses which are partly for business, partly for personal. So my friend Karthik is sitting here. So generally when the time is at 5:55 in the office, he will become slightly jittery. So, sir, may I leave, sir? So I used to wonder what is making him rush at 5:55. So one day 5:55, another day 6:05. So alternate days. Then only I realized his name is Karthik. So therefore every alternate day he rushes. Assuming he uses his vehicle and he's also earning income. So the income tax officer will come back and say, Karthik, after 5:55 or 6:05, you're leaving the office and going with your friends. Don't say that is business purpose. It is only personal. So he will say, I will disallow 20%. So similarly, the examiner also gives you 20% of the car is used for personal purposes, 10% of telephone is used for personal purposes. So this is how section 38 operates. In the examination, it's a very easy section because they have to give in the examination how much out of certain expenses which are used for personal purposes. You simply add back to the extent of personal purposes. It's going to be disallowed under section 38. So 40A contains all tax related, and there are three sections which are very important, which is 40I, 40IA and 48III. These three of these sections deal with disallowance relating to non-deduction of TDS or delayed payment of deducted TDS. Then you have section 40B and 40BA, which basically deals with interest and remuneration paid by partnership firm or an association of persons or body of individuals to its partners or members. Then you have section 40A, which is applicable for all SSC, which in turn has got subsection 2, which is related party transactions. Subsection 3, which basically deals with payments made otherwise than by account paid check or account paid draft. Or 40A7, which is provision for gratuity. And section 40A9, which deals with provision for non-statutory or unapproved funds. So section 43B, another very important section, which provides for disallowance in respect of unpaid liabilities. Normally, expenditure will be allowed as reduction on due or accrual basis if you follow mercantile base of accounting. If you follow cash base of accounting, expenses will be allowed only when you actually make the payment. So what 43B is trying to do is, it allows certain expenditures only on actual payment. So therefore, normally you can claim whether you make a payment or not. The 7 expenditures which are covered by 43B will be allowed only on payment basis. Therefore, we can call 43B as an exception to the general rule that expenses are allowed on due or accrual basis if you follow mercantile base of accounting. So we'll go to each of the sections in detail now. First, section 38, already explained. If your expenses which are partly used for personal, partly for business, will be disallowed in section. So I've just put 3 pictures here, which is normally the way in which the examination questions are structured. 10% of your telephone expenses are personal, 20% of car for personal, 25% of the building is used for personal. So whatever expenses relating to car like depreciation, repairs and maintenance are add back the portion attributable to personal. Now similarly, whatever expenses relating to building to the extent attributable for personal purposes, you disallow. Very easy adjustment in the examination. Examiner will specify how much out of your phone or car or building is used for the purpose of official or personal. Depending upon that, you have to add back the amount attributable to personal purposes. So let's move on to another very important section, section 40A. As I said, 40A basically deals with TDS related disallowance. Already you have in TDS provisions. If you don't comply with TDS provisions, interest is there, penalty is there, prosecution is there. But still, disallowance under 40I or IA brings more complaints. So whenever you tell your client, if you don't deduct TDS, the expenditure will be disallowed, then he generally complies with the law much better than any other consequence. That's why you have this particular disallowance. So 40I, we can classify that into the payments covered into 4: interest, royalty, FTS, or any other sum chargeable under this act. So which is payable outside India or in India to a non-resident if you are not a company, or to a foreign company. So essentially what they are trying to say, foreign company need not have to be a non-resident or resident. Foreign company always is covered by this section. But if you are not a company, it covers only a non-resident. So possible reason is interest is deemed to accrue or is India under 915. Royalty is deemed to accrue or is in India 916. FTS is deemed to accrue or is in India under 917. So any other sum chargeable tax. Therefore, generally the government believes the interest, royalty, FTS generally accrues in India. Therefore, the tax is payable in India. Therefore, withholding tax or TDS will be attracted. Or any other sum chargeable tax. If you make a payment outside India, it is taxable in India, you have to deduct tax. If you don't do it, then 40I will provide for a disallowance. So when disallowance will be attracted? First, you should have deducted tax source, but you should have not done. So that's the first point. So deductible, but you have not deducted. The second point, you have deducted, but you have not remitted the same before the due date for filing tax returns under section 139(1). 139(1) provides for filing of tax returns by various categories of assessees on various days: 31st July, 31st October, 30th November, and so on and so forth. So 139(1) due date is the date within which you should remit. Now, very important note, the TDS remittance you have to do every month or by the 7th of the following month. If you deduct in the month of April, you should make the payment by 7th of May. If you deduct in the month of May, you should remit by 7th of June. But to disallow the expenditure, you have to make the payment after the due date for filing tax returns, which could be 31st of July. Now they have changed 30th September to 31st of October. So for if you are writing May examination, you can read it as 30th September. If you are writing November examination, then it should be taken only as 31st of October only. So for the month of March, you have more time. You can remit by 30th of April. So therefore, it's very important to note, it is not necessary you should remit the TDS amount by TDS due date. You have to remit only by TDS due date. Just give an example. If I have deducted TDS in the month of April, I should pay by 7th of May. And assuming my due date for filing tax return is say 30th of November, I should make the remittance only by 30th November of the next year. So therefore, to that extent, you can find there is more time is allowed for disallowance when compared to the TDS provisions. So that is one very important point you should understand. So what if you make the payment in the subsequent year after the 139(1) due date? Whether this section is a permanent disallowance? The answer is no. So what the section provides, if I deducted already but remitted after 139(1) due date, then I can always claim the deduction as and when I make the payment. But there are two parts here, just read it closely. Where in respect of any such sum, tax has been paid after 139(1) due date. That means I have deducted, but I am making the remittance after the due date for filing tax returns. Whereas the second part of the section, deducted in any subsequent year. That means I should have deducted in the month of March. If I deduct only in April, then even if I make the payment within time, I can only claim the deduction in the next year only. So therefore, delay is allowed only for remittance, not for deduction. So I can delay the deduction, then I will suffer the disallowance. If I delay the remittance, I will not suffer the disallowance part of it, so long as I make the remittance before the due date for filing tax returns. Even if I make the payment after the due date, I can claim as and when I make the payment. So I'll just give a very simple table for you to appreciate this particular point. If not deducted, simple issue from the examination point of view, not allowed. If for assessment in 2021, if you have deducted in the month of April 19 to March 2020, any day, then it will be allowed as reduction if you make the payment by due date for filing tax returns, which could be 31st of July, it could be either 30th September or 31st of October or 30th of November. When I said 30th September or 31st of October, there is an amendment proposed in this budget. The due date will be 30th September has been shifted to 31st of October, which will apply from November 2020 examinations, not for May 2020 exams. So, if you make the payment after 139(1) due date, you can claim in the year in which the payment has been made. So, this is about 40I. So, 40I and 40IA, two differences are there. One is 40I basically covers non-resident payments, whereas 40IA covers resident payments. Whereas in the case of 40I, 100% is disallowed. Whereas in the case of 40IA, I'm only going to disallow 30%. So therefore, there are two differences. If you notice, the rest of the section is same. There is no difference at all. So on this background, we look at 40IA. 30% of any sum payable to a resident. As I said, there the section applies for payment to a non-resident or a foreign company. Here it will apply for a resident, on which tax is deductible as source, not deducted, but has not been paid before 139(1) due date. The provisions are identical except for the first one. Instead of 100% of the sum payable, it will be only 30% of sum payable. Rest of the section is same. You don't have to worry about it. Resident payment, non-resident payment, 30%, 100%. So those are the differences. So 48 III deals with the disallowance in respect of salary payments. Even today, salary to a non-resident is also covered only by a section called 192. So normally non-resident payments require deduction to 195, but salary deduction for resident or non-resident both fall under the same section, which is 192. If salary is paid to a resident outside India or to a non-resident India, 48 III will cover. If tax has not been paid or deducted as source, then disallowance gets deducted under 48 III. So these are the three sections related to disallowance. I've just given the comparison in the subsequent slides, which you can go through leisurely. So that you can understand the difference between 40I, 40A and 48 III. So the comparisons are there, so you can leisurely go through that. So with that, we'll conclude this session. So other disallowances will take it to the subsequent. So we have seen the provisions. Now it's now time for looking at some problems, considering that 40 is a very important provision. Interest payable outside India, tax deducted in the month of March 2020, remitted on 30th July 2020. So if the TDS is deducted in March 2020, first you must understand TDS provisions say this has to be remitted by 30th April 2020. But however, for claiming deduction under 40IA, if you recall, the amount has to be paid by due date for filing tax returns, which could be 31st of July, 30th September, 31st of October, 30th November, as the case may be. So 30th September, 31st October, you might be confused. 30th September is the due date up to assessment in 1920. There is a proposal in this budget to extend the due date from 30th September to 31st of October. So therefore, that's why I said the due date for filing tax return has to be this. So let's not worry about that. So in any case, you have a minimum due date of 31st of July. So 30th July 2020, this expenditure will be allowed in the previous year 1920 itself. Take the next one, interest payable outside India, tax deducted in July 2019. If you deduct in July 2019, the last date for making a remittance is 7th of August. April to February, you have to pay as per section 201, which is the due date for payment of TDS under chapter 17B. 7th of the following month, except for March, where you have time till 30th of April. 7th of the following month, which will be August 2019, but remitted on 30th July 2020. Again, there is a delay in the remittance, but still you will be in a position to claim the deduction because the law requires you to make the payment by due date for filing tax returns. So we have another example. Salary paid to a non-resident in India without deduction of TDS 15 lakhs deducted and remitted in the subsequent year. So we take it as subsequent, and let's take this as 18-19 is salary and the payment is made in the subsequent year. Then only you will be in a position to understand this particular question. Now, whether salary paid to a non-resident in India is covered, the answer is yes, because if you go through 48 triple I, you will find payable outside India or in India to a non-resident. So, if the payment is made in India to a non-resident, section will be still applicable. There is no deduction of tax, there will be disallowance. So, if you deduct and remit in the subsequent year, unlike 40I or 40IA, there is no provision to cover the subsequent payments. Therefore, in examination part of view, you can take a very simple stand. If you have not deducted, subsequent deduction will not help you in the case of 40A triple I. So, be it is, take that. But whereas when you take this one, salary paid to resident in India, this is not covered by 48 triple I. This will be covered by 40A IA. In 40IA, you can remit the amount. If you deduct and remit in the subsequent year, you are eligible to claim. So, I just want you to understand in both this question, salary of 1819 deducted and remitted in 1920. So, that's what you should understand. So, though it is not specifically stated in the equation that the salary pertains to 1819, for an understanding the equation, you should take a stand. Salary of 1819, TDS not deducted in that year, subsequently deducted and remitted. If it is paid to a non-resident in India, it will be covered by 48 triple I, disallowed. And whereas if it is resident covered by 40 IA, you can claim in the subsequent year, which is 1920. This also highlights the difference between 40I and IA on one side, 48 triple I on the other side. So let's take one more example. A royalty payable outside India in 1920, tax deducted in July 2019, remitted on 30th July. Already we have seen a similar example for interest. July 2019, I should remit by 7th of August. I have remitted by 30th July, no problems at all. You will still get the amount as deduction in previous year 1920 itself. So warehousing charges paid 10 lakhs, TDS deducted 184C instead of 184. This is a very interesting case. Now warehousing charges, already Supreme Court has said that TDS is required only under 194X. So if you do not know the TDS provisions, don't worry. So once you go through the TDS provisions, you will be in position to understand this particular point. So rent requires TDS in the 194I, contract requires deduction under 194C. So if you deduct under C wrongly instead of I, whether disallowance can be attracted, that is the issue. So if I apply a wrong section and as a result of it I have not deducted the correct percentage, can I subject to disallowance? So you have some conflicting decisions. Calcutta High Court says no problem. If you have deducted under some other section wrongly, no problem. Short deduction is on account of I applied a wrong section, still that will not attract disallowance. Whereas the Kerala High Court has taken a stand. If we apply the section wrongly also, there will be a disallowance. So obviously your question will be, what should I do in the exam? So Calcutta may something, Kerala may say something, sir, what should I do, sir? In examination, any one view will be accepted. So if you apply a wrong section, as a result of there is a short deduction, you can take stand, no disallowance. Alternatively, if you apply a wrong section and as a result of there is a short deduction, you can say expenditure will be disallowed. Any view will give you full marks in the examination. But you should understand what is the issue behind this particular problem. So let's move on to 43B. So 43B, just like to recollect what I have already mentioned. Normally, if you follow mercantile base of accounting, expenditures will be allowed on due basis. So if you don't make the payment also, no problem. If you follow cash system of accounting amount, then you have to make the payment to claim. But 43B acts as a very important exception to this rule. So that's why this section also starts with notwithstanding anything contained anywhere in the act. This is called as the non-obstante clause. So when I provide like this, then what does it mean? Even there is some other section is inconsistent with the section, the provisions of this section will prevail. This section will override. That means if I say in some other section the amount is allowed on payable basis, whereas 43B says you can claim only on payment basis, which section will prevail? Only 43B, because of the non-obstante clause of 43B. So basically this section shifts the amount deductible from due basis to cash basis. There are totally 7 expenditures are covered in 43B. 1 plus 1, 2, 3. So for an easy remembrance, I just put as 1 plus 1, 2 plus 2 plus 3, 7. The first one, any tax, cess, duty, by whatever name called. And then second one, use of railway assets. So normally all direct taxes are already disallowed. If you make a payment of income tax, you cannot claim. So therefore, basically 43B will apply only if the expenditure is otherwise allowable. Otherwise, income tax is not allowed. I can't claim income tax through 43B just because there is a non-obstante clause. So basically, 43B only covers indirect taxes. Okay, for example, all of you may be aware of GST. I can pay by 20th of the following month. So what if I don't pay the GST? So I can only claim the year of payment. But there is one small catch here. Like 40I and 40IA, I need not have to make the payment before the end of the year. I have to make once again only up to due date for filing tax returns. Why it is? Take a very simple example. March GST I can pay by 20th April. I pay by 10th of April. So I have complied with the GST laws. Can income tax that come back and say disallowed? The objective of this particular section is to ensure that, so if you are liable to pay indirect taxes, you cannot claim by simply making a provision. So unless you make the payment, you should not be allowed. So here, I have not only made the payment, I have also made the payment within the due date as per the GST laws. So if you strictly apply 43B that you should make the payment up to 31st of March, even if I make the payment on time, I will be subject to disallowance. So therefore, for 40I, 40IA and 43B, the government gives you extended time till the due date for filing tax returns. So all indirect taxes covered here. Then use of railway assets. So if you use a railway assets for carriage of your freight and other things, you can claim it as a reduction, but unless you make the payment either before the end of the previous year or before the due date for filing tax returns, you cannot claim. Then you have two interest payments are covered. So I've just used some abbreviation, but however I'll elaborate. Interest on capital borrowed from public financial institutions like your IDBI and so on. State financial corporations, state industrial corporations like Tamil Nadu Industrial Corporation, so it's called as TIC. So those interests, if you make the payment up to due date for filing tax returns, you can claim. Otherwise, you can claim only when you make the payment. So any interest on loan from a scheduled bank, again you have to make the payment either before the end of the previous year or before 139(1) due date. Two interest payments are covered. You must bear in mind, except interest on capital borrowed from these financial institutions, industrial corporations and scheduled bank, other interests are not covered. Assuming for a moment, I have taken a loan from another company, inter-corporate deposits. I have not paid the interest. Can I claim? Yes. 43B does not cover all interest. It covers only the interest from either financial institutions or state financial corporations or state industrial corporations or from a scheduled bank. Then three employee related payments are covered, which are Provident Fund and ESI, bonus or commission, and then leave salary. So these three employee related. So totally you have seven. Three employee related, two interest payments, one indirect tax, one use of railway assets. So when should I make the payment? We already discussed about this particular point. So if paid on or before the 139 due date, you can claim in the current year itself, in the year in which you have to pay the liability. If you make the payment after that date, then it will be allowed as and when you make the payment. That is why this particular section can also be, from the point of view of accounting standard 22, acts as a very important example for a timing difference. So assuming you make the payment after due date for filing tax return, in accounting you would have debited in 1 year. In tax, it will be allowed in the next year. So this results in a timing difference. So 43B is one of the very simple, powerful example for AS 22. So let's move on to the next one. So the employer's contribution is allowed as reduction at a 36.14, 36.5 allows again the employer's contribution to gratuity fund. So these expenditures, as we have already seen, 43B covers any employer's contribution to PF, ESA or any other welfare fund. We have already also seen, though the PF has to be paid by 15th of the following month, though ESI has to be paid by 21st of the following month, Income Tax Act allows you time till due date for filing tax returns. If your due date is 31st of July, April 2019, you have to pay by 15th May 2019, but to claim deduction, I can pay up to 31st of July 2020. So what about employees' contribution? As you can easily understand, the purpose of this particular section is to make the employees pay the PF on time. No employer is going to pay his contribution alone. He has to deduct from employee's salary That also he has to remit along with his own contribution. So therefore, protection is there for employer's contribution. What happens to the employee's contribution? The employee's contribution is also now protected in the law by first considering that amount as a income first. So suppose if I am an employer, I pay Karthik salary of 1 lakh. 12% I have deducted as a PF, which is 12,000. The moment I deduct this 12,000, it is considered as a deemed income of mine. This I have to note by PF due date. So what if I don't make the payment by PF due date? Interestingly, it says the amount will be allowed as 3615A. 3615A puts the due date as the due date as per the PF Act. So now we have a very peculiar problem. Employer and employer's contribution, both I will pay by a single challan money. Normally both are paid together. I can pay the employer's contribution up to due date for filing tax returns. Whereas the employee's contribution I have to make by PF due date. What if I don't make the payment by PF due date? The amount becomes a deemed income on the plain reading of the section. However, some assessors were trying to take a very interesting stand, which is a pretty logical stand also. So, the employer should pay not only his contribution, he should also pay the employer's contribution, though he is entitled to deduct and make the payment. For example, let's assume for a moment, I paid salary to Karthik without deducting PF. Am I still liable? The answer is yes. So I should have deducted tax at source. I have not deducted. Whether my liability there is still there. So I should have deducted GST. I should have collected GST. I have not collected. Well, I am liable to pay GST. The answer is yes. So therefore, similarly, the PF obligation, if I don't deduct, also continues to remain with me. Therefore, some assessors were trying to take a stand. The amount payable in 43B not only includes employer's contribution, it also includes employee's contribution. Because 43B is an overriding section, so they were trying to take a stand. Both employer and employee's contribution, you can make the payment up to 139, one due date. Though on a very plain reading of the section, you can observe employee's contribution, time is only PF due date. But they are trying to take a stand. What is sum payable by the employer in 43B? Amount which he is liable to pay out of his own contribution, plus the amount which he has deducted from the employee's salary, that also is liability only. Whether he deducts or not, he has to only make the payment. So both will be covered. Some courts have accepted this stand and some of them have not accepted the stand. So the two popular decisions as far as the favor of the department is concerned or favor of the revenue is concerned, Gujarat High Court and also the Kerala High Court. So Mecum Limited, but Gujarat High Court took a stand. PF due date should be the due date here. Same ruling is followed by the Kerala High Court. This ruling is also today followed in Madras High Court also. So 3 High Courts in India have taken a stand. Employees' contribution should be paid by the PF due date. But the rest of the country follows a different method. So they say that you can make the payment up to due date for filing tax returns. That means the sum payable in 43B not only includes employees' contribution, it also includes employees' contribution. Being a student, as usual, you will ask the same question. Sir, all this controversy I find, sir. Kerala High Court said that, this High Court said that. What should I do in the exam? Again, same point. Till such time this issue is resolved by the Supreme Court, you can take any view in the examination. So if you want to take a simple view, 3615 says due date as PF, I'll go with it. Alternative view, the due date for the purpose of employee's contribution is also 43B due date because employer is not only liable for his contribution, he is also liable for employee's contribution irrespective of whether he deducts the same or not. So that's how the controversy was. Very interesting controversy. With that we will end this session. So we'll meet you soon. Thank you very much.